Then I go to my operating expenses. They're going to work just the same way as the receipts did. It's the units per year multiplied by the cost per unit for the first year. The second year is going to be the first year's amount multiplied by 1 plus the growth rate on expenses. And you want to do the F4 around your expense growth rate so that it'll keep that cell reference fixed as we drag it across. So I drag it across to fill those in. And one thing you'll want to do is then just look at these numbers and say, are they behaving the way that I would think? They're all going up a little bit, so that looks good. I'd also just click on a random one and see what it's doing. Just see that it transferred everything over the way that you'd expect it to, and it did. Same thing with the expenses. Look over. So the next thing we have is depreciation. And for our livestock, our 3-year property, it's going to be the amount of the livestock with an F4, because we want to always refer to that same amount, multiplied by the rate for the first year. And then as I drag that over, the next year is going to do the year 2, the year 3, and the year 4 amount. Plus, I've got to depreciate my buildings and equipment. And so I can open parenthesis buildings, F4, plus equipment, F4, because they're both listed as 7-year property here. Technically, buildings would be over a longer period of time, but we built it in this way. Then multiply all of those by the rate for the 8-year property, or 7-year property. One thing to notice is that this is a 7-year property, but we have 8 values, and that's because the first year, the IRS tables only give you a half a year's worth of depreciation, and then year 2 is really half of the first year's plus half of the second year's, and so 8 would be half of year 7's. The final, you get a half year in that final year. So now I can take that depreciation amount and just merely drag it across the whole way. Interest is equal, IPMT is the interest portion of a payment. I got to give it the rate, which is my finance rate, F4, comma, the number of periods, which is the years financed, F4, comma, it's asking for the period that it is. So that's the payment that you're making. In this case, it's the year. Then, comma, NPER is the total number of periods, so that's the years financed, F4, comma. The present value is the amount that we financed, the initial investment, F4, multiplied by the percent financed, F4. There is no future value, so we can close parentheses. So just to kind of reiterate here, we've got our rate, which is the finance rate. PER is the period of the payment we're making, 1. We didn't do dollar signs around this or F4 because as we drag this across, we want the next one to refer to the second payment, the third payment, the fourth payment, and so on. And then, comma, we've got the present value, or the total number of payments that we make, which is 10. And then, comma, the present value, which is the initial investment multiplied by the percent financed. If I hit enter here, it's a payment, the interest portion of a payment, but it's still part of a payment, so it's going to display as a negative sign. And I would need it to be a positive because I'm in my cash outflows. I know it's a payment, so I just put a minus in there, and it displays as a positive. So now I can just drag that all the way across. Here you'll notice that in year 10 you have this dollar sign value. For some reason, over here, this cell, it's not reading it as a 0, it's reading it as something else. So you can type a 0 in there and it works, or you can type a 0 in here and it'll work, but that's the problem, that's what's going on there. And then principal, my principal portion of the investment, I can copy this IPMT down, and then I've got to make some adjustments. I need the principal instead of interest, so I'd want it to PPMT. This rate is still here, that's right. But now instead of C19, I need C18. As that brings me back up to the first payment. And then everything else is correct, so I can hit enter. And then drag that all the way across. One thing that it's nice to do is your total payment is $19,822.23, and so you can highlight the interest and principal in any of these years and look down in the corner here and it'll say $19,822. So that kind of gives you some check that you've drug and everything's doing what it's supposed to be doing. Okay, so the next thing we need to find out is our taxable income. And this is how much money are we going to have to pay income taxes on. So it's the cash inflow minus everything that can be deducted. Our operating expenses, we pay money for them and they can be deducted. Our depreciation can also be deducted, and our interest can be deducted, but our principal isn't tax deductible because that's just paying for the assets. So it's just deducting operating expenses, depreciation, and interest. Hit enter. In this case, it's a negative taxable income because after we've deducted that depreciation, we're losing money. Copy that across, and then our income taxes is going to be equal to the taxable income multiplied by the tax rate up here of 20%. We want to do an F4 around that so we can drag that across. And we do that. And you'll see in some of these years, since we had a negative taxable income, we have a negative income tax. And as what this assumes is that you have positive income from another source that you can deduct this extra $12,000 against, and so you'd end up paying $2,500 less in taxes. The next thing we need to do is find our cash outflow, and that's going to be our down payment. Operating expenses are cash plus that. Depreciation, you don't use cash for, so we don't include it. Interest plus principal, we use cash for. And then taxable income, we don't actually pay cash out for that, but we do for income taxes, so we include that. And then we just copy that all the way across, just drag it over. And now we need our net cash flows, which are going to be equal to our inflows minus our outflows. In the first year, it's minus $28,000 because that's our down payment. And then I can drag that across, and you can see all of those different amounts. The next thing I have down here is something called CUMCF, or it's just our cumulative cash flows. So in the initial year, it's just going to be the initial amount, but the next year, it's going to be the previous year's amount plus this year's cash flow. And then we can just drag that across. And so at the end, we've gotten the money that we invested back, that $28,000 plus an additional $37,647. And so we can look across here, and at the end of year 1, we still haven't got our initial investment back. At the end of year 2, we haven't, 3, 4. But here 5 is the first year where it's positive. So our payback period is 5 years. And I don't have this actually programmed in. It's just something that you can type in. Because you'd need a bunch of nested if statements to do it, and I didn't think it was worth programming. But now the only thing that we've got to do is find our net present value, our internal rate of return, and our MIRR. So the first thing is net present value. So it's equals NPV, open parentheses, the rate, in this case it's the discount rate, comma, and here's where you got to be careful because we want to include the net cash flows for year 1 through year 10. You've got to close your parenthesis and then say plus year 0. So year 0 is outside the parentheses. And you hit enter, and we lose $731 on this. So we know already that this IRR should be less than 19% because we have a negative NPV. We're not making quite 19% on this investment. So the next one is IRR equals IRR, open parentheses, and then we want our values. And so minus 28 up to the positive 19, year 0 to year 10, close parentheses, hit enter. And it's 18.26. So our internal rate of return is 18.26%. You can see that it does get a little confusing as I'm going up and down. So one thing you can do here is go in when you have up on top what you want to have displayed and click View, Freeze Panes, and then I can scroll down and it'll leave all that information up there. So the next thing is the MIRR, so equals MIRR, open parentheses, my values, so my cash flows for year 0 to 10, comma, the finance rate, so the finance rate, comma, the reinvestment rate, which we're assuming is the discount rate, and then close parentheses. And so the IRR is 18.26%, which is less than the discount rate, and the MIRR is 18.69%. So the MIRR will always be slightly closer to the discount rate than the IRR, because the IRR is either going to be slightly understated if under the discount rate and overstated if over the discount rate. Since this is an IRR that's fairly close to our discount rate, you don't see a whole lot of difference between the two. So once you have these decisions, something to remember is that numbers don't make decisions, people do. And sometimes, even though we said we wanted 19%, you can see a negative net present value like this and say, well, you know what? This really fits into what I'm doing. It's something that I'd like to do. It helps me use my facilities better, da-da-da-da-da. You know what? I don't think I really need to make 19% on this. Maybe it's only 15%. And then you can observe the results again as you make changes to that. You can also have a situation where you could even have a slightly or a positive net present value, but say, you know what, this isn't really worth it to me. This is going to take me away from other investments that I really need to keep my eye on that are more important to me, and so I don't, even though this will make me a little bit of money, it's really not worth it to me. The other beauty of this is that the reason to put it in Excel like this is now I can use this generically for other investments and other situations, and that's what you're going to do in the homework for this module. You're going to revise these numbers in green once you build this, and then also take these depreciation rates and change them into the rates from page 85, and then you'll do it for another situation. And that concludes Module 10 and the time value of money.